Hey there, Singaporean investors. If you've ever felt overwhelmed by a tidal wave of market news or lost track of how today's headlines could shape your SGX holdings, you're in the right place. Welcome to the Investing Iguana's daily SGX Market Digest for July 30th, 2025. I'm Iggy, and over the next few minutes, I'll break down what really happened on the Singapore Exchange today and share my take on how it could affect your money. As always, you'll get clear, actionable analysis. No jargon, no noise, and definitely nothing you'll find in the headlines that just distract you. Before diving in, here's a quick bit of context. The Investing Iguana is proud to be ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We're celebrating over 1 million reads, and with more than 900 videos and 500,000 watch hours, this is your channel for real-world financial clarity. Our goal is to give you both key SGX updates and the bigger picture so you're never caught off guard, whether by local news or international trends. Let's start with the market as a whole. The Straits Times Index drifted gently downward today, closing at 4,226 points, slipping just under 0.1% versus the previous session. Even so, the STI remains impressively strong, having risen almost 6% in the last month and more than 22% compared to this time in 2024. The momentum built since Singapore crossed the 4,000 mark is still echoing, buoyed by robust earnings from local banks and steady investor appetite. But the air is cautious right now. Market watchers are keeping a sharp eye on global signals and the latest moves from the Monetary Authority of Singapore, especially after a recent rally that pushed the STI to an all-time high earlier this July. Turning now to the standout SGX companies moving the needle today, let's first look at Hotel Properties Limited. The talk of the town is that HPL is continuing discussions on redeveloping Forum the shopping mall alongside Voco Orchard Singapore. They made it clear there's no guarantee of a deal, but just the possibility of a big transaction in one of Orchard Road's marquee spots sent HPL shares surging more than 6%, ending at $5.54 before a trading halt was called in the late afternoon. The message for investors is simple. Property plays in key areas like Orchard Road can spike fast, even on speculation, reflecting the region's intense demand for iconic assets. The next step for HPL will depend on whether these redevelopment talks yield concrete results or just keep the market guessing. Next up is Hongkong Land, a heavyweight in Asia's office and retail property scene. This group staged a solid comeback, swinging from a net loss last year to chalking up $297 million in underlying profit for the first half of 2025. Even though revenue fell to $751 million, down about a quarter from the previous year, this turnaround has caught the market's eye. Hongkong Land's shares closed up over 2% at $6.39, reflecting renewed faith in its management and strategy. The key signal here is that even when core earnings dip, sharp cost control and well-timed property plays can drive major profit recoveries. Moving on, Keppel REIT reported a small dip in its half-year distribution per unit, down to 2.72 cents. But dig deeper, and you'll notice property income actually jumped more than 9% to $136.5 million. This was mainly thanks to the newly acquired 255 George Street building and higher occupancy at 2 Blue Street. Keppel REIT's units ended the session up 1% at 95 cents. The bottom line, strategic acquisitions are making their mark, and while headline payouts are a touch softer, the underlying business is gaining steam. Switching gears, let's look at CapitaLand China Trust, a REIT focused on China's commercial and retail sector. Its distribution to unit holders slipped more sharply, down 17% to 2.49 cents, pressed by lower rents and a weaker yuan. Revenue also retreated nearly 8% to around $159 million. Yet the trust managed to hold NPI decline to under 10%, partly offset by careful cost management. Its units closed flat at 78 cents, showing investors are holding steady, perhaps waiting for signals on China's economic direction before making big moves. Starhill Global REIT, which owns well-known Singapore malls like Wisma Atria and Jian City, posted flat earnings at $74.5 million for the half year. Revenue nudged just 0.5% higher thanks to its Singapore retail properties and modest currency gains. Notably, shopper traffic at Wisma Atria climbed about 5%, even as overall tenant sales slid a touch. Starhill's steady results in a choppy market could appeal to investors craving consistency over drama. Now let's talk about Far East Hospitality Trust, which was weighed down by a softer half year. Its distribution fell over 9% to 1.78 cents, while net property income slipped to 45.6 million. The slight income drop was blamed mostly on weaker hotel performance and higher property-related costs, although some overseas properties did help balance things out. Its units edged down to 61 cents, signaling that investors are looking for a clearer recovery in hospitality before jumping back in. CDL Hospitality Trusts also faced headwinds as ongoing renovations at the W Hotel took a bite out of profits. Net property income dropped nearly 12% to $58.6 million, with the biggest hit coming from a $3.2 million slump, directly tied to the hotel upgrades. Core Singapore property income also slipped more than 20%. Despite these setbacks, the trust's units only dipped to 85 cents, showing investors may still trust in the long-term upside once renovations finish and RevPAR, or revenue per available room, rebounds. Finally, First REIT reported a 5.8% cut in its distribution per unit, now at 1.13 cents for the half year. Revenue fell about 3%, mainly because of weaker regional currencies like the rupiah and yen. Net property income also ticked lower, settling at just under 49 million. Here, the recurring story is how relentless currency shifts can dampen real estate returns even when tenant demand is stable. First REIT's units closed flat at 28 cents, showing a market that's cautious but not panicky. Pulling it all together, the big theme this week is contrasts. On one hand, we're seeing strong performances from Singapore's traditional blue-chip banks and stable retail REITs. On the other, there's clear pressure on hospitality names and any company exposed to currency volatility or foreign real estate risks. The STI's remarkable run-up this year shows that investor confidence in Singapore remains firm, especially versus regional peers, but we can't take this for granted. My advice is to stay nimble and diversified. Recent listings like Infotech Systems and NTT-DC REIT have breathed new life into the SGX IPO market. While established players keep proving that strategic moves, like property upgrades or asset purchases, still drive long-term value. If your portfolio leans too heavily on one sector, now's the time to ask what happens if global winds change. Be wary of chasing yield at the cost of quality, and look for names that balance steady local income with some exposure to global growth. That's all for today's digest. If you found this update useful and want in on deeper, earlier market insights, check out our premium membership. It's only $1 a month and gives you a real advantage with advanced analysis and direct alerts. As always, please like, share, and drop your thoughts in the comments. I really do read them all and love hearing what you're watching in the markets. For those wanting to up their basics, don't miss my episode on demystifying the Straits Times Index. That's linked in the video description. Thanks for tuning in to the Investing Iguana's daily SGX Market Digest. Keep your eyes open, and good luck navigating these shifting markets.